Okay, we're going to start the next session. I'm glad we have a little bit of a break there. I always feel awful stopping the shoes anyway, well, I think we all agree that last panel was unbelievable. I've got to always pinch myself when I see people I've known for so many years who are absolutely at the top of the profession and who come and share their wisdom with us. This is another one of those panels. This is a panel on healthcare or healthcare distress situations. And it, again, has people who I've known for years and have really are at the top of the profession. We're lucky to have them together. The panel is moderated by Sam Maizel. Sam's a partner at Dentons. He leads the firm's healthcare industry restructuring efforts nationwide. He's the only attorney, according to this, he's the only attorney in the United States ranked in both healthcare and bankruptcy by Chambers, and also best of Wow, that's amazing. He also has been awarded restructuring lawyer in the year 2020 by Global M&A Network. On a personal level, I've known Sam for years. When I always introduce him as, you all know that he's the leading healthcare bankruptcy lawyer in the country. So let me turn it over to you to introduce the rest of the panel who are fit into that category as phenomenal leaders.
Thank you, Harold. Can people hear me in the back?
No. You have to close the door or you have to speak up louder.
Oh, I can speak up louder for sure. I can't close the door from here. I was a little worried when Harold started that because he was talking about the panel before, how great it was. I thought he was going to say, in contrast, we've got this panel. So we're going to talk for about an hour on healthcare. Can people in the back hear me now? Better. Is that okay? Yeah? More? I can do more. I mean, I was an infantry officer in the Army. I can project over the band on a parade ground, so I can do this. All right, so let me introduce the panel, and then we'll start talking. So to my immediate left is John Romero, who's the managing director at Angelo Gordon. He's a senior member of the healthcare team. He does buy-side investor, both public and private, distress, special situations, everything in the industry from pharma to hospitals. Previously was at Morgan Stanley. To his left is Michael Lane, who's listed as an independent advisor, because if we listed all the firms he's been at in his 4 decades of experience, it would take up whole pages. He just suffice to say he served as a financial advisor, CRO, CEO of various healthcare entities. He's got a tremendous amount of experience, both M&A and operational issues. He's worked personally with me in the Estrella healthcare case recently in Yakima, Washington. Before that, he was the CRO of Trotman Hospital and numerous other engagements. To his left is Susie Koenig. Susie is the founder and CEO of SAK Management, which runs about 70 nursing home, skilled nursing facilities around the country. She's a hands-on operator of skilled nursing facilities, but she's also been a receiver, been the patient care ombudsman in various cases. She's probably been involved in 15 to 20 bankruptcies and 20 to 30 receiverships. I like to say this, she is the inaugural member of the iWork Restructuring Hall of Fame, admitted this year in their first class, which I think is quite an achievement and well-deserved. To her left is Peter Chadwick, who's the managing director at Berkeley Research Group. He also has been CEO, COO, CFO, and financial advisors of various healthcare entities. Most recently, I worked with Peter when he was the CFO and financial advisor to Berkeley Health System, which is a $1.6 billion, the second largest nonprofit healthcare hospital bankruptcy in American history in California. And as Harold said, I'm Sam Maizel, and I'm a partner at Dentons in the Los Angeles office, and I run our distressed healthcare efforts nationwide. So we're going to talk about healthcare. There's a reason healthcare always shows up as one of the unique industry-specific programs in these conferences is because healthcare is 20% of the GDP of the United States, and no matter where you want to invest, what kind of industry you want to invest in, it will fall within the healthcare industry. So it could be provider, patient-facing opportunities like hospitals, skilled nursing facilities, ambulatory surgical centers. It can be things that are more residential, like continuing care retirement centers, independent living facilities, assisted living facilities. If you like transportation, medical ambulances and transportation is a huge industry. If you like the IT space, then electronic health records, medical records, cybersecurity is a huge issue in healthcare. Hospitals are regularly subject now to ransomware attacks. And think about the importance in this segment of the American economy for just something like cyber attacks. Because in hospitals, it isn't just that you can take control of all the billing, which is all electronic, but now terrorists can take control of actual patient care because it's all electronic based. So if you can hack into a hospital system, you can literally put patients' lives at risk, not just the billing system. There is nothing that America does that doesn't fall within the healthcare space. Pharma, IT, cyber, patient-facing, supplies. McKesson is a huge producer, a huge American company that produces primarily in the healthcare space. No matter where you want to invest in the American economy, you will inevitably touch on healthcare. So we're going to talk about the impact of the pandemic. We're going to talk about where we are today in the healthcare industry, and then we're going to talk about where we think we're going and where there'll be investment opportunities. Okay, so I'm going to turn it over to Peter to just start going through the slides, but I'll make everyone contribute as we go through. So you're up, Peter.
Yeah, I'll start with hospitals because hospitals are a great proxy for talking about the 5 forces affecting the healthcare system, the providers in healthcare. And that transition, the pressures that are facing hospitals and the healthcare system started long before COVID, the increased costs, lower volumes, lower reimbursement as population ages, and the dominance of health plans in setting reimbursement rates. That all started before COVID. COVID exacerbated all those things. And some of the things that COVID exacerbated are probably permanent changes to the delivery of healthcare. And that means that the model for delivering healthcare, all those providers, has to change to adapt to that. Some of the things you see, the outputs of that are discharges is our proxy for volumes. That's people discharged out of the hospital. Are down 10% year to date versus 2019, the sort of pre-COVID benchmark. And that's broken out between the 2 funnels for a hospital are its ER and its surgery. Those are the 2 places that draw patients into a hospital. Those are each down, 4 to 5% versus 2019. Those may be permanent changes, given the way healthcare delivery works in America. On the flip side, costs continue to grow. Length of stay is how long a patient is in the hospital. You're only paid for so much care for that patient. The longer they're in the hospital, the more money you're losing. In some cases, you're losing 25 cents the minute a patient walks in the door. If they're there for longer than the median average or the median, the U.S. median would be for that diagnosis for the patient, you're losing exponentially more. Labor rates have also gone up. Labor rates have gone up for a number of reasons, but the biggest factor is what we show here, which is turnover. This is in hospitals. Turnover in hospitals is about approaching 30% a year for nurses. Turnover for skilled nursing centers is approaching 60% a year. You're having to replace almost all of your nurses in 18 months in a skilled nursing facility. So that has ballooned the costs, not just of bringing in contractors in healthcare, but in retention costs. You've changed the base wage you're paying people, and and there's a lot of stats behind that, but my favorite is Kaiser Permanente just renegotiated their contract with California Nurses Association, good friends of Sam and mine, and they agreed to a 22.5% rate increase over 4 years. Think about that in any business, much less a business where reimbursement rates are going down. So that's the dynamic that they're facing in healthcare. So the stress applies to all of them. When you think about the labor factor in and of itself, you know, I defer to Susie, who's on the front lines more than anybody really in how permanent that change is, or whether it's something that's correctable in the near future.
Well, let me add something on the ED visits, because the ED visits are down in totality, but the admissions are not. So you're still getting admissions coming from the ED visits, but the walk-ins, the people that aren't really quote emergencies, they're not coming in. They stopped coming because of the COVID issue. And on the other side of it, even on the physician practices, a lot of the clinics that I've been involved with, or as the CRO or CEO, is the clinic volume's down as well. So people are just delaying during this COVID situation. They're delaying going to see, providers because that's where sick people are. So when they are showing up, they're showing up in the emergency room. In oftentimes the ambulances, the acuity level that they're coming in is much higher. So you've got that layover. And then a piece that's not on here is a lot of the outpatient surgeries have dropped dramatically. Sam and I were working in Washington, and I was part of the C-suite, and we got a lovely letter from the governor of Washington that said, you will stop all non-life-threatening elective procedures. Orthopedics, GI, most general surgery, even some cardiology could not be done with this is life-threatening. That's not returned. I've been surveying friends and colleagues and providers across the country, same thing. It has not returned. So that's the high profit margin business that a lot of hospitals rely on. And that's adding to the woes of lower revenue, lower reimbursement, and higher costs.
Let me just add a couple points, because I view my job as the moderator is to translate some of this for people who don't work in the healthcare space. So lower volumes, if you think of a hospital as like a hotel where we provide medical services, you think volume is great, and obviously it's important for a hospital just like a hotel. The difference is the way you get paid in a hotel is you get paid for every night you stay. In a hospital, you get paid for the services that is being provided. And so if you go in for hip replacement and you get to stay for 3 nights, they get paid one rate for the hip replacement. And that means the length of stay causes the hospital to lose money, not like a hotel where the longer you stay, the hotel makes more money. So think when you feel like you're being rushed out of the hospital after a surgery or a procedure, it's because you are. And you are being rushed out because the longer you stay, the less money, actually the more money the hospital loses on your procedure. And I say the more money it loses because that's the other point I wanted to make sure I explained, which is they were talking about getting paid 25 cents the day you walk in the hospital. That's because Medicare and Medicaid, which are the largest payers for hospital visits in America, pay less than the cost of care. Which is why when you open the New York Times and you read the articles about how Blue Cross Blue Shield is paying 3 times, or it's usually not really 3 times, it's probably 150% of what Medicare pays. That's because Medicare pays like 85% of the cost of care. The hospitals have, and it's not just hospitals, it's skilled nurse facilities as well and other providers. They have to make up those losses by overcharging being a relative term, other payors to make up the difference. So when you go in on your Blue Cross ticket, you are subsidizing all the patients that are paid for by Medicare and Medicaid.
Actually, he's actually wrong on something. Because the charging is the same. You cannot charge different rates to different patients for the same type of procedure. So if I have a Medicare patient that's getting hip replaced, or I have a non-Medicare patient getting hip replaced, the charges are the same. What's different is what you're getting paid for that. So
I'm a bankruptcy lawyer. All I care about is what we get paid.
But charging, it's not charging, they're not charging differently. You're getting reimbursed differently by Medicare versus commercial. And you negotiate a lot of those managed care rates. A typical way to negotiate managed care rates is to say, I want 300% Medicare rates.
Yeah, the contracts will literally say that Blue Cross Blue Shield will pay 300% of Medicare rates, because that way when Medicare changes, their rates automatically change as well.
Irrespective of what your charges look like.
Right. And this, if you're investing in this space and you're looking at accounts receivable or their balance sheets, you need to be aware that in a typical hospital or skilled nursing facility, they don't have the ability to figure out what they're supposed to be paid. So they will book every transaction at a rack rate, their charge rate, and then they will, well, at least in the hospitals I see at the bottom of the food chain, they will rely on the payer to pay what they're supposed to be paid, and frequently are not capable of checking, so they will just assume that what they got paid was correct.
And you're dating yourself a little bit because it's a lot better than that nowadays. Systems are much better.
But
Not in the
also,
hospitals I work with.
yeah, but
That's a
also,
problem.
many of you may have known too, during COVID, elective surgeries just kind of stopped. And those are the high-paying types of, as we're speaking here, but you didn't say that the elective surgery stopped. So they did. They've started up again, but as a result, those elective surgeries, that's where the downflow goes into the skilled nursing. So a lot of that admission, because we're looking at all the numbers, those admission rates have gone down too in the skilled nursing. So starting at the hospital level, it affects all systems in the healthcare food chain.
So Susie, why don't you just keep going and talk about the pre-COVID issues
Okay.
that we've been discussing that we see
Yeah.
more of now.
So pre-COVID, many healthcare, as we say, much of it lacked automation. Healthcare has always been the last system, the last organization to become more technology-based. And as a result, it's a very labor-dependent type of field. There's many low-skilled positions, and there's a lot of talent shortages. But it's also COVID brought about a lot of new technology, in particular telehealth. I know many of you are hearing about that in your physician offices. The elderly don't necessarily like telehealth. They still like to see their doctor come to their bedside and talk to them. But in the hospitals, especially during COVID, and in the skilled nursing facilities, there would be an iPad, literally, standing there with the nurse, standing right next to the patient, and the doctor would be doing the exam with the nurse over the technology. That was incredible, and that came on as a result of just COVID and circumstances. And now, we're all dealing with this post-COVID, and there's a lot of issues. There's a lot of payer issues, there's a lot of reimbursement issues, and everyone is trying to figure out how really to put a dollar amount in these types of inventions that have come about because of the COVID-related circumstances.
Well, telehealth has been around a long time. I was dealing with telehealth. I was the interim CFO for the International Division of Harvard Med School. I was on an annual basis, and we were dealing with the Kingdom of Saudi Arabia, and we were working to provide telehealth, radiology telehealth between hospitals in Boston and the Kingdom of Saudi Arabia. So it's been around. It just hasn't been universally adopted, and COVID brought to light that people didn't want to go see doctors in person. But the problem is, for a lot of things that you're going to see a physician for, you have to be there in person. I know that I have to see a hematologist twice a year, and I have to see him in person. He cannot do telehealth by law because of the drugs I'm on. He has to see me in person. So there's a lot of that hasn't been worked out yet. And then the state laws, in terms of how telehealth is enacted, if a physician is in New York and they have a patient in another state, they have to in most instances, be licensed in that state of where the patient is. So if they're not licensed, but they're licensed somewhere else, they're not going to get paid, and then in some instances, it's a violation of Department of Health issues in states. California is the worst for anything from a reciprocity basis. So there's a lot to be worked out, and a lot of the payers are still fighting it a little bit. They want to pay the doctors less for a telehealth visit, say a psych consult, which is very favorable for telehealth, but the payers want to pay them less. But the doctor says, look, I have to talk to them for 50 minutes anyway. Whether I'm in person or whether I'm on telehealth, why are you trying to pay me half? So there's a lot of that to be worked out.
And in senior housing, what's so interesting with skilled nursing, in certain states, if you do telehealth, and if you have an RN that is kind of like the supervisor, you're missing RN hours on your floor because you have to have a certain minimum amount of hours for nursing in skilled nursing. But if you have an RN that comes on a telehealth prompter and talks to your staff on the iPad, you can get that counted in your reimbursement as a reimbursable hour for that person to talk to you over the computer.
Right, telehealth is here to stay. And I think that when you look at, part of our business is just working with private equity companies on strategic opportunities, and we do a poll every year with our private equity clients. And every year in the last 3 years, one of the top 3 investment opportunities from their perspective was in telehealth. Now, people can't actually articulate what that necessarily means, right? Because as the other 2 speakers just pointed out, it's very complicated to make sure you're getting reimbursed for it, so there's a return on your investment, and your ability to leverage it can be limited by regulations. But all that being said, telehealth is here to stay, and it is and will continue to be one of the largest investment opportunities in healthcare. And I think in subsegments, you are going to continue to see it in places like skilled nursing, and then psych. Psych is telehealth is here to stay, and so I think telehealth is one of the upside opportunities here in healthcare.
Yeah, let me just do another translation. So there was a reference to senior housing. So again, the healthcare industry is quite broad. So this could be, I think, senior skilled nursing facilities, right? So nursing homes, as they used to be called, skilled nursing facilities like Susie owns and runs. But it also can be assisted living. So think more like a community for older people who need some assistance with the daily activities, bathing, cooking. It can be independent living, and then it could be, so even further down, step down, in terms of what care is provided. And then it can be in a continuing care retirement center. You'll see the term CCRC, and that can be a large campus that has all 3 types, skilled nursing, independent living, assisted living on the campus. So I think that's what we're talking about when you hear the term senior housing, senior living.
But in particular in skilled nursing, and as Peter said, behavioral health is also a great investment, and you're going to see telehealth, as you said, from a psychiatric perspective, because in a lot of these communities, especially rural communities, you don't have the abundant psychiatrists, psychologists, specialized psychiatric services that you need. And so telehealth is a perfect opportunity to be able to bring that service to the forefront of where the patient is being treated.
Yeah, so one of the things you'll read about in this space is all of this in the healthcare industry in particular, because it's heavily regulated, is fits and starts. So telehealth's been around for years. The pandemic gives it a great boost. Medicare and Medicaid expand their coverage of telehealth. And now there's a lot of investigations by federal and state regulatory agencies into telehealth, because with the speed in which it ramped up during the pandemic, there wasn't a lot of clarity into what would be permissible billing, not permissible billing. And so now what we're seeing is a lot of investigations as to whether it was properly utilized, whether it was properly billed. What were the requirements for simple things like signatures with regard to the care being provided, right? So it's like everything else in this industry because it's so heavily regulated. There's always shakeout periods, fits and starts, I like to say. So,
Actually, Sam, before you leave that slide,
please.
from my vantage point, as a buy-side investor focused on the high-yield market and similar companies of that size, they tend to be a little bit bigger than some of the companies you guys deal with. The thing that jumps off this page to me is the contract labor that's getting the most attention right now. If you take some of these companies that I've focused on and you look at just the last 4 quarters of performance, for many of them, these are multi-billion-dollar companies with billions of certainly EBITDA, revenue and potentially EBITDA. They're spending on a quarterly basis more than $100 million more than they normally would on contract labor. It's a big number for those companies. I can only imagine what the contract labor impacts are on some of these smaller companies. It goes to one of the charts on Peter's prior slide about cash on hand. There's been a real drain. I think about the last couple of years and sort of summarizing COVID as 2020 was about liquidity coming into the system, and it propped up providers in many respects, and it was important to do that. 2021, you had a little bit of the benefit of that still. You had higher reimbursement for certain procedures, and things were sort of getting back to normal. So you had a little bit of the pent-up demand that wasn't there in 2020 coming back. So it was actually a pretty good year for a lot of providers in 2021 until the second half of the year when labor started to become more of a problem. And it comes down to all the points that are on this slide, whether it's burnout or childcare or just all sorts of issues that have driven it, but turnover is high, and some of that is related to nurses going and saying, I can make a lot more as a travel nurse than staying local. And the travel nurse definition doesn't mean I'm moving 3,000 miles away. It may be that I'm driving an hour and a half to get there, and I can make 2 or 3x. So the dynamic right now for a lot of these providers, again, we're focused on the hospitals, and the epicenter of the provider universe has been pretty significant, hundreds of millions of dollars above what they would say that their baseline contract labor spend has been. And so again, for these bigger companies we're focused on, some of them are going to really struggle with that and with their capital structures. Others are going to be okay. It's just a matter of a drain on resources. For the smaller companies, and why I think there's going to be a lot to do for these guys in particular in the hospital space in the next few years, that's not going away quickly. If you talk to these CEOs in the bigger companies, they would tell you that rates have come down in the second half of 2022 for those contract labor arrangements, but the usage actually, the utilization of the contract labor hasn't come down. It's been pretty sticky. And an anecdote as we head into the end of the years, usually flu season, if you have a large flu season, it's what a net positive, not a huge deal, but a net positive for hospitals. The hospitals these days are going to be faced with, do I actually use contract labor to staff up for that volume? Because what was already not a great profit margin, because a lot of it's Medicare, and we talked about the difference in rates for Medicare, we're going to eat that up with the contract labor. So the labor issues that we're all hearing about across all sectors, I think are particularly acute in healthcare, and they're hitting the hospitals the hardest. Other companies outside the hospital space in the provider world have different sort of ripple effects from that. But that's the biggest thing that jumps out on this page to me.
And skilled nursing is, as Peter said, 60% of the labor force is turning over. And COVID, again, was to thank for a lot of that, because many people, as the slide says, are retiring and just leaving healthcare because they don't need that. There's burnout, there's a lot of mental health as we all know it, and the vaccination requirements are not all the same. Some of the healthcare facilities are not hiring people if they haven't had the vaccines, and others are saying we can't afford not to hire if they've had it or not. And it goes back and forth to the ethical issue, to what's the law and what's not the law, and how do we deal with it. And so that's going back and forth. And as a result, contract labor is hitting the market in all levels of healthcare, and there's just not enough people to staff in healthcare anymore. And even contract labor, they're having issues finding staff.
Sam, before we leave hospitals, can I just make the case for investing in hospitals, just hypothetically?
Yeah.
It's obviously an opportunity for restructuring professionals or turnaround professionals, because it has all the great elements, right? They were levered up during a period where the world's totally changed. So the original business thesis is totally gone. So they're over-levered. They're drastically reducing cash on hand, so that's our proxy for liquidity. So they're running out of liquidity. Their cost structure needs to be fixed. And these systems have a preponderance of contracts. They run off of all these contracts. And so your only opportunity to really renegotiate contracts, both what you're getting paid and what you're paying other people, is to sort of get a clean slate to renegotiate all the contracts. And so the thesis, so there's obviously restructuring opportunities. The thesis for investment is that there's an opportunity to change the way hospitals provide care. And so bankruptcy in particular provides the best opportunity to really reshape the delivery of care, because it gives you a forum to fight the regulators. And so what your hospital of the future probably won't be is the place you go from birth to death for everything in between. It'll be very specific to your market, to what other people are providing in the market. Not every hospital will provide cardiac care. Not every hospital will have an oncology. Pediatrics, not every hospital will have PD. They will begin to specialize, and then the further you get from the epicenter, so the more rural you get, they'll have less and less services. And they'll basically be an entry point into the healthcare system. So there's an opportunity where you can get into the space at a very depressed price and restructure how they provide care and how you're paid for providing that care.
Peter, for what it's worth, that's similar to how we're thinking about it. We have invested in a couple of different hospitals through the debt structure in the high-yield markets, and what we're looking for ultimately is the system or the footprint that can adapt. Because if they're not going to be able to adapt, we think more surgeries are going to leave the inpatient setting and go to the outpatient setting. All these factors they're going to be slow moving to fix unless you get to some sort of real restructuring. And so we're looking for companies that have the flexibility to become maybe more of a health system than just a hospital. And that's very, very much aligned with what you're saying there.
I think you're fast moving to mega systems. It's funny because I looked at an old presentation from 12 years ago. Every one of these issues that we gave to a board 12 years ago was the same issue. And you go back 20 years, 30 years, it's the same thing. I think the hospitals are very resilient. They're very good at predicting or trying to react to what the regulators are doing. And frankly, you still need them. The big guys, though, are getting much bigger. HCA's getting bigger, Ascension's getting bigger. Baylor Scott and White in Texas, they control probably 70% of the population of patients in Texas. Geisinger on the East Coast, Kaiser on the West Coast. Those guys are going to continue to get bigger and bigger and bigger. And they're not necessarily buyers because they can pick and choose. So if you've got a nice 250-bed hospital that's right now maybe marginally profitable or slightly less profitable, they'll probably buy them. If you're losing tons of money, they'll just wait for you to die, and they'll just leave it in that marketplace. They're just going to get bigger. We're going to end up with mega systems, and it's been moving that way for the past 15 years or so. I think it's going to continue that way.
Yeah, I think what I've frequently said about the industry is the middle class, like in America generally, the middle class is disappearing. So what you're having is huge systems, Ascension, HCA, that ilk, where Ascension has like a $30 billion investment fund. Sutter has a $20 billion investment fund. They're going to survive no matter what happens in the healthcare industry. And then you've got a single standalone small rural hospital, or the system we worked in Yakima, Washington, where it's two hospital systems survive, one of which is, I think both of which are about 25 beds. And they're going to feed into larger hospital systems. They're not going to provide all care. They're going to, as described, they're going to be an entry point. And I think you're seeing that. And that's what you should expect, because if you think of how we deliver healthcare today in America, it's completely different than the model on which the hospital system was built, right? So the hospitals, a lot of the hospitals in America today, the system started in the 40s and 50s after World War II. And if you had projected the population of today and the number of hospital beds you need to service that population based on hospital bed usage in 1945 or 1950, you would need way more hospitals than we're going to end up with. Because now hospital care is different. You know, heart treatments are now, you take pills, or they put a tube under your leg and they fix your heart and you're in and out of the hospital. Or, you know, personal example, my father had his hip replaced. He was in the hospital for a week and then he was in a rehab center for 2 weeks. I had my hip replaced. I was in and out of the hospital. It was same day surgery, right? I was in the morning, home at night for dinner, and I went to see a rehab person for a week or two, and then and not inpatient, right? Just somebody at basically a gym. And so the hospital system we have is poorly designed for the way we deliver healthcare systems today. And it's, you know, the shakeout is what you're going to see. 5,000 hospitals, give or take. They're going to be about half of that in 20 years.
And we keep calling them hospitals, and we should probably stop calling them hospitals at some point, because they really won't be hospitals, right? They'll be population health companies, and they'll have a hospital. Sam's analogy is on point. The hospital is really just a hotel that you fill up for certain reasons. So they'll have a hospital, then they'll have physician groups, and they'll have clinics and ambulatory surgery centers. And they'll have behavioral and psych, and they'll basically manage, and they'll get paid to manage a population of people. And so what you'll have is, you will have these particularly academic-driven hospital systems that will have huge geographic reach. But then you'll have smaller systems like Lehigh Valley in Pennsylvania, where you'll have a 6 to 10 hospital system that has 20 clinics and ambulatory centers, and it has its own health plan. And it has, 100 doctors that it has in the hospital system. Then it has 2,000 doctors in its physician group practice that's spread all around the community. And so, yeah, I mean, it used to be a hospital, but what it really is it manages the healthcare for a population, and ultimately that's where healthcare will go. And so you won't really refer to them as hospitals anymore. They will be population managers.
Or it'll be an acute care center, and then you end up in their other center, and you'll be going down the line.
And so there's opportunities both on the grand scale, the major players that are national or multi-regional, and then you have the smaller players that are still important. And they're, look, Lehigh Valley's a $2 billion health system, right? So there's real money there, but it's a much more microcosm of the larger. And as you move into being your own health plan and taking on risk and managing larger and larger physician groups, you end up finding ways to make money that have nothing to do with the bricks and mortar of a hospital.
All right, so I wanted to move on to one of the other, we inevitably end up talking about hospitals for a bunch of different reasons. But I did want to talk about skilled nursing, which is, as the population ages, increasingly more important. And so this, Peter, do you want to just take us through these slides quickly, and then we'll...
Look, the story is very similar in skilled nursing. Skilled nursing has had a dramatic drop in, as everyone can imagine, right, in occupancy during COVID. It is struggling to find its way back to pre-pandemic occupancy levels for a lot of reasons. Part of it is the staffing is probably the biggest issue. Staffing is a capacity restriction. You don't have enough staff to staff every bed in the building you own. And so you can't fill all those beds. The second point is that sometimes you don't want to hire the staff because it's just too expensive. You're not getting paid enough to bring the staff on for that extra bed. And the other big point is that, look, the beauty of healthcare is the government gets to change the field goal posts all the time. And so whatever your business model is today, it's going to have to adapt to something very different tomorrow. And in skilled nursing in particular, they took away the biggest profit center in skilled nursing in therapy. So instead of getting paid for every hour of therapy, you're basically getting an allotment based on the acuity of the sickness of the person in your facility. And so between regulation, reimbursement, and labor, skilled nursing facilities are in a lot of distress. And I say skilled nursing facilities, I use that as a bit of a proxy for all senior care. But you can see the dynamics are very much the same in skilled nursing. It is to the hospitals. One of the differences in skilled nursing is, look, capital structures define at the end of the day what your avenues for restructuring are, right? In hospitals, you do have a significant amount of debt. In nonprofits, you have a lot of bond debt. In skilled nursing, more and more, you have real estate. And so your debt is in the form of a lease. And so your prospects for restructuring are different.
Yeah, and when we were talking before the panel, Susie made a good point about the way these REIT contracts have been written historically. You want to talk about the escalator clauses?
So I sit on the board for REIT. I'm a board of director, and it's been interesting over the last several years, real estate, buying up all of these facilities. It's all been, the wave of what's happened. Now, all of a sudden, we're seeing a lot of distress, and REITs have never had this amount of incredible distress happening at every level. Sometimes you have certain operators in the past that maybe didn't perform as well, but it's all across the board. And again, going back to the fact that staffing is the biggest expense right now, and so it did me well because during our last meeting, everybody turned to me and said, okay, now what do you do? How do you turn this around? Well, there are ways. Skilled nursing is still an opportunity for investment if they're run correctly. And the escalators on the REITs, what has happened in the past is when the escalation at every single year on these lease contracts continue to go up and up, when they were bought originally, they were bought at the level that they could pay. And now, every single year, these escalators on the lease go up, and you can't really, the REITs are at an impasse because of the staffing expenses.
And the REITs are also at an impasse because they're frequently publicly traded companies. And they issue 10-Qs, and they have to tell their investors what their projected rates of returns are going to be, and they're all tied to the escalator clauses. So if now, as we're seeing in the industry, people want to renegotiate those leases, it creates a huge problem with investor and REIT expectations.
Right, and historically, those REITs would resolve this problem. There's been waves of senior care, so skilled nursing, assisted living, independent living, restructurings through the years. And what REITs historically have done was they would give you a holiday. They would either give you a period where you didn't pay any of your rent, or they would give you a period of significantly reduced rent, and then they would just throw it on the back end. Right? So it wasn't really a restructuring. Now you're at the point where the values are so different between the value of the land. These are typically sort of single-use facilities. So the value of the land versus the value of the lease that sits on top of that land. And so it's not just a restructuring opportunity in healthcare. It's a huge restructuring opportunity in healthcare. But it's also, when you look at the balance sheets of the REITs, a REIT problem, because you have a valuation problem. You have a balance sheet that massively overvalues the underlying assets. And so at some point there has to be some reconciliation of that.
And in the past, a lot of people got into this business not realizing that operations was the key to how these things really need to function. The real estate people that got into this business, it was real estate. It's no longer that kind of play. It's now all about operations. Because if you can operate, and Peter talked about it a little bit before, renegotiating contracts. It's one of the biggest things that we do when we go in on the turnaround. You got to renegotiate the contracts. And even the therapy levels, as Peter was saying, it was taken away. Actually, on the operating side, it wasn't. Because if you can teach the staff how to operate, it's no longer on the contracted side. It's actually good because from a reimbursement side, you teach the staff how to care for the patients. And if you have a higher a patient that has more acuity, has more issues and more medical issues, you can get paid more on the therapy side if you teach the staff how to care for those residents. And we call them residents in skilled nursing. In hospitals, they're called patients. It's the same thing. But again, there's opportunity on the restructuring side in the skilled nursing if you have good operators. It's now the year of the operator. It's no longer what it used to be. So when looking at these investments, make sure that you have a good operations team, because a good operations team is now going to carry it through. Staffing is still quite difficult no matter what you do, but because the level of staff, people again left. But the care delivery is the way you really need to go. And again, it's still a good investment. We're going through a very, very bumpy time now, and you're going to see that is going to be one of the largest restructuring areas that you're going to see going forward.
Okay, let's we got about 10 minutes left. So let's talk about M&A activity. So and since we actually have someone who does buy-side work, John, where this chart shows where BRG thinks the work is. Where do you see?
Oh, actually, go to slide 12 if you would.
Okay.
Sorry.
No, happy to.
Because it'll break it out in a second. So there you go.
Yeah, so we, not being an advisor, I don't necessarily focus my time on the M&A aspect of the market, but certainly we're involved with names that either get bought or sectors that are going to be consolidated or in a consolidating mode. From my perspective, one of the biggest hurdles right now as we sit here today is financing. Because the deals that I'm looking at or I'm helping to finance specifically tend to be private equity backed and they tend to use a fair amount of debt. Right now, within the bulge bracket banks, there are a lot of deals that they signed up to over the last 12 months that they're not able to move off their books right now. And so you're seeing sort of this bottleneck from that perspective, which I think leads to probably a little bit of a lag over the next 12 months in terms of larger LBOs, unless, and this is very much possible, the private debt capital that's out there comes in and sort of fills in the holes that the banks are not necessarily able to finance right now, given the issues they already have on the books. So I'm expecting a little bit of a lag relative to what we've seen, whereas in 2021 you saw a couple of pretty large LBOs in the healthcare space. I don't know that we see that in the next 12 months for that reason from a financing perspective. Not so much because people believe that demand for healthcare is changing, that some of these opportunities aren't real ones. It's just a matter of how do you finance it. Maybe more specifically in subsectors, and then I'll turn it over to others with their view. I mean, we've been involved in dental in a few different ways in the last few years. We think that's a space that will continue to consolidate, and that consolidating makes a lot of sense for that space. In the pharma sector, we haven't talked about that much here. It too has gone through a lot of changes through COVID. One of the issues is you can't market to the doctor in the way you used to be able to. Things have changed. Either doctors got used to not having sales reps show up at their office, or they decided to sort of slow the cadence of letting people in. So commercializing a branded drug is as hard as it's been ever, especially if you're a smaller company. And so I think you'll see the natural sort of evolution of the food chain in pharma, where bigger companies will buy smaller companies for specific assets and slot that into their bag. So I think a lot of that will continue. And then maybe I'll tee it up to you, Mike, from a hospital perspective. At some level, there's got to be more M&A. Maybe the FTC makes that harder than it's historically been, but I would imagine there are assets that make sense to trade.
There are. The Trump administration took a very hard stance against hospital mergers. The Biden administration took it to a whole new level. So they're challenging all these mergers. So there's some big mergers that have fallen through just because getting into protracted fights with the government is not good for either side. So they're making it more difficult. You still have certificate of need laws in a lot of states that require approval. If you go from a not-for-profit to a for-profit, you have to get approval from the Attorney General in most states. So that makes it more difficult. And then there's a lack of buyers. I'm a reformed investment banker, so I have a little bit of background on this. There's a lack of buyers right now. So some of the second tier, if you get past the mega giants like HCA and Ascension and all those guys, a couple of the second and third tiers, they're in trouble. One of the bigger health systems that's been very active in buying distressed hospitals over the years, it's public knowledge, Prime Health, they just got downgraded to B, single B. Their debt's B minus with negative outlook, which is not good. Some of the other ones in the same space, which I won't mention because I've got relationships with them, are struggling. They were active buyers. So a lot of these active buyers that have been rolling up a lot of these troubled hospitals over the years are struggling. We've had some recent bankruptcies. A company filed, they own some hospitals in California and Chicago, and they're selling them to former hospital administrators or CEOs who have some money behind them. You're not giving the top tier organizations their buyers. And I think they're going to pick and choose. And the multiples and the valuations are not good right now. I've been doing this for a long time. The healthcare hospital multiples have been 6 to 8 times cash flow forever, for as long as I can remember. That's great when you're making money, but when you're not making money and you've got very, very low single-digit EBITDA multiples, you're starting to look at 25, 30, 40 cents on the dollar of revenue instead of 100 cents for maybe a profitable hospital in years gone by. So there's a lot of debt that's going to have to be covered. Restructuring tax-exempt debt, the vast majority of hospitals are still not-for-profit. Restructuring tax-exempt debt, and then there's people that worked on it, is very, very complicated. It's very complicated. What ends up happening is the hospital gets sold in a robust process, either in bankruptcy or outside of bankruptcy, and can then convince the bondholders that this is the best deal you're going to get. That's what's going to happen. It's that or closure. There's been some closures recently in the last year or so, after robust sales and nobody showed up to buy, certainly not to cover the debt. There's a lot of hospital systems out there that are debt to revenue is almost 1-to-1. That's almost impossible to make money at that level. And it's almost virtually impossible to try to get out from under that in an M&A process. So they're distressed sales.
And one of the things that I saw over the last 3 years was, so the pandemic shuts the hospitals again, back to hospitals, but they shut the hospitals, emergency rooms, and elective surgeries, which drive patients. But then the hospital's liquidity actually went up because there was huge infusions of cash from Medicare and government recovery programs. So hospitals that had terrible cash flow from operations were sitting on more cash on hand, days cash on hand, than they'd ever had before. Now that is gradually being eaten away, and the patient base is not coming back. Some people in the industry still query where did that pent-up patient demand that people expected, where is it, right? Because people who didn't have their hips replaced for 3 years, there should be a lot of them waiting, but they're not coming back. Where are they? But so cash flow from operations is not recovering. Between inflation and labor costs going through the roof, costs have gone up. They're eating through all the liquidity that's still left from the pandemic assistance. And so I wonder what does that portend for the next 12 months?
And paybacks. The government started to do audits for paybacks of stimulus funds.
And no one kept records
Yeah.
because they were going so quickly and money was given out without really checking who I mean, you've heard about all the fraud with all the PPP loans. Same thing was going on in a lot of the healthcare facilities. You know, now they're going back to check records and having to prove up. And so you're going to find a lot of different things happening.
But there's still a lot of opportunity. I mean, look, I agree with everything everyone said, and I could be super pessimistic, which I was warned about last time I was on this panel. And
That's why they put us on the panel. More pessimistic.
But look, if the hospital's the sun in the universe, right, there's a lot of other things that orbit that are enormous opportunities, and you can tell they're enormous opportunities, not because I said it, but because you can see the explosion in transactions. So the explosion in transactions in e-health, which is, you know, the technology associated with telehealth. Senior housing, behavioral, which is both, there's two tranches to behavioral, there's psych, and then there's addiction treatment, and both are very popular right now. In particular, psych has grown massively over the last 12 months. And then labs, lab transactions have grown. And that's probably just a sort of normal cycle of life, growth, and then breakup. So, look, my mantra has always been, where there's a lot of M&A, restructuring must follow. And there has been an incredible amount of M&A over the last 24 months. Some of them jammed through so quickly, particularly in Q4 21, that you wonder whether there isn't a wave of restructuring that follows.
Well, we're up at our hour, so we'll take a question or two.
Can you guys talk about surprise billing and thoughts there?
Yeah, John.
Yeah,
John, it's this one.
it's a whole other panel. but it goes to the regulatory point made earlier. A lot of the stress in the high yield market right now comes back to companies that are facing changes related to the No Surprises Act, which is the regulation associated with surprise billing. So there are a lot of companies that are forced to change in short order to new regulation and frankly new leverage points in negotiations. A lot of what we talked about here came back to, in healthcare, you're negotiating for everything, every last cent you can, and oftentimes most of what you're getting comes from commercial payers, United, Aetna, Cignas of the world. And when the landscape changes and you can't quite get what you need from them relative to what you historically have, it can be a real transformational issue for your business. And you're seeing that in a number of cases right now. And those tend to be sort of around in those concentric circles outside of the hospitals, but they're very much relevant, and certainly a part of the reason why the healthcare market within the high yield indices this year is performing along the lines of automotives and housing, right? Not what you would expect kind of in terms of down 13, 14% year to date, but it's a lot of these issues we've talked about, including the Surprises Act, which is not a COVID specific issue. It was boiling prior to that, but it's finally coming through, and there's a lot to be worked through there still.
Yeah, go ahead.
So the previous panel talked about repurposing real estate, and like where I come from in San Diego, we have a number of senior care facilities that they're decades old, and they are on prime real estate in a lot of these more expensive cities. In San Diego, that's the case where I'm from. Acres and acres of really nice real estate. And if you go to their web pages, they're offering 3 months free move-in and promotions like that. What is the potential, for repurposing some of that real estate? And is there regulatory friction that would not be the case for other?
Yeah, let me just repeat the question because I know people in the back can hear. The question was about repurposing, if you've got a hospital frequently in prime real estate, think St. Vincent's here in New York, or skilled nursing facilities, can you repurpose them? Does that make sense? Is it even possible?
Yeah, and there's a lot of people out there that go out and appraise that and can take a look at that because a lot of the, depending on where you're located, regional, county, state specific rules and regs for that, but you can't.
It depends. It's not sounding about planning, but
Right.
it depends. Repurposing a hospital is very difficult.
Hard.
Because not only do you have to get over the hurdle of closing the hospital to then repurpose it, which is regulatory run, but then you need to get it rezoned for something other than a hospital, and they hold all the leverage in that. So that's very difficult.
Counties.
And the other thing with a hospital is, just from a construction standpoint, because I've gone through this a few times and worked with contractors and architects. The way hospitals are built, there's a lot of mechanicals in the walls. It's very difficult, it's very expensive to break down walls in the interior, because you have to get rid of all those mechanicals, because you have all the oxygen, you have all the electrical, every room has all the, all the necessary needs for the patient. It doesn't lend itself to an easy construction project.
But repurposing the land, if you want to knock it down,
Land
is,
the opportunity.
that's the difference. But the physical buildings, as Mike and Peter
Hard.
said, it's very hard. And on the senior care side too, the skilled nursing side, it's the same thing. I mean, there's certificate of need statuses, you have to resell beds, you have to give the beds back, depending on the local zoning is really the way it goes. But mostly the land would probably be available. The buildings, it costs a fortune. You're better off building, new than repurposing these old buildings.
And this is one of the places where regulatory authorities are incredibly difficult. Shutting a hospital in San Francisco is an 18-month process, during which time you're sustaining all the losses, just to shut it, not even talking about trying to get it rezoned. Bankruptcy, we do it in 2 to 3 weeks, but if you don't do it through bankruptcy, you could be 18 months just trying to shut the hospital, then go through 2 or 3 years of fighting to rezone it, if you could do it. Well, I know we're being carted off here. Thank you very much.
Getting the back.
Thank you.